What's up, guys? Thanks for tuning in. Let's take a look at the 1 hour time frame of this British pound USD forex trade. Right now it looks like we've got a bearish bias on the pair, and the reason I make this point is because this whole range bound consolidation area up here is more than just a point of reference, it's actually a clue. In fact, this trading area provides us with a chance to assess our bias, since first and foremost, it not only outlines our range, but also identifies this stop hunt expedition area, a well-known liquidity grabbing smart money tactic, which, as you can see in the chart, is followed by a bearish order block and then this retracement that obviously leads up to a more complete picture, if you will, of this distribution phase. And now a failure of price breaking through the order block's base here and reaching new highs would further validate the case for a bearish bias. And this is due to the fact that when substantial demand diminishes after reaching a peak in activity, it indicates a change of character in the pair's price action as the supply side gains dominance. Certainly, the inability of the price to move higher here suggests that we may be in for a potential shift in trend. However, I think that we need further evidence at this point before concluding which direction the pair will take. And this is where, and as I switch here to a 1 minute time frame, this is where the formation of this bearish order block comes into play. I think that examining it can give us greater insight on what to expect next. What I mean by that, and as you can see in the chart, is that after the market breaks formation or breaks structure are the same thing. So after we break formation, the market goes through a brief stage of choppiness before making a series of pushes in the direction that the market making side wants the price to move, which is obviously upwards and towards the order block's origin. Now notice how price swiftly breaks through the base of the order block but stumbles when it comes to pumping through its ceiling. One thing that you should keep in mind, guys, is that these technical details are not only indicative of the pair showing range-bound short-term tendencies in terms of remaining restrained within a particular trading range, but also signal a shift in the direction of the market. Now I intentionally use the term shift here as this upward movement before the reversal starts to take place is the final component when it comes to understanding how the smart money maximizes its profits via a three-step manipulative tactic clearly designed to grab liquidity from traders. Instigate, trap, and shift. Each step has its own purpose in this grand scheme. Smart money operators plan in advance their moves in the market by executing buy and sell orders that alter price points. By stirring up activity, they first induce and then trap traders into entering the market before shifting prices back in their favor to extract liquidity from buyers and sellers alike. It's worth noting that smart money have an edge on the market since they know not only how much retail traders are willing to buy, but also where and when this group will be looking for attractive profits. Clearly, these heavy market players do possess access to ample resources and data that puts them a step ahead of competition. Additionally, understanding the point at which smart money can drive orders without causing exhaustion among other market participants, including retail, of course, is, I think, a key element of their skillful approach to securing liquidity. So one thing's for sure here, instigate, trap, and shift aren't just buzzwords. These are components of an active and obviously deceptive tactic, giving the smart money the upper hand by strategically playing off of traders' uncertainties. And yes, these sneaky practices are unfair and they do suck literally. But at the same time, this is the nature of the business. After all, deep pocket players such as big banks or institutional traders aren't in the game to lose money. They want profits too. So we have to accept this fact and navigate accordingly. And by navigating accordingly, I'm referring to traders avoiding getting trapped by the smart money's liquidity grabbing tactics by first understanding the motive behind a particular price movement being presented to them, and then question, is it meant to benefit a potential trend, or is it intended to create false volatility? This knowledge can help you differentiate between legitimate trades and those that are more likely to be smart money traps. Second, traders should always do their own research. Don't chase and don't take advice at face value. Make sure, guys, that you analyze your chart for technical patterns on the trade you are considering before making a decision. I think that taking the time to truly understand price patterns and make rational trading decisions is the only way to protect yourself as a trader from getting outfoxed by sure smart money tactics. Getting back to our point of interest, which qualifies as a secondary test, when trying to enter a trade inside such range-bound order block type zones, you must keep an eye on where price could go, but more importantly, where it might reverse. And this area up here appears to be a good spot at this point, therefore I would set a 6 pips stop loss with the potential to make up to 78 pips according to these targets. Also, guys, don't forget that reading range-bound trades the right way is key to your success in short-term trading. These types of trades, I think, should be the foundation on which you build your strategies. Alright, gang, I hope you found this video to be helpful and informative, and if you did, please make sure to like and subscribe to the channel. As always, I would really appreciate it. Thanks again for joining me, and I look forward to seeing you in the next one.